There's been a lot of crazy economic news that's come out lately, but this last one came out and hit me straight in the face. No, that was actually an elbow from somebody in jiu-jitsu the other day, but the show must go on, so do your best to disregard both of these black eyes. But anyway, so much news points to some craziness coming in the stock market in the very near future, and give my thoughts on what could happen at the meeting tomorrow and how to invest because of it. The highlight of this week will be the annual Central Bank Symposium in Jackson Hole, Wyoming, which kicks off on Thursday night and runs through Saturday. And the showstopper of that event, at least for Wall Street, is likely to be Federal Reserve Chair Jerome Powell's speech scheduled for 10 a.m. Eastern Time Friday. Economists expect Powell to forego committing the U.S. Central Bank to a specific path for monetary policy, although he could emphasize continued inflation risk after last week's strong economic data. Markets have already priced in a possible September rate cut, and this will definitely potentially limit the upside for stocks. This is so important to note. If you look here, you can see the market implied odds of a single 25 basis point cut to the target federal funds rate at the Fed's September 17th and 18th meeting, and you can see what people are thinking for a 50 basis point cut, according to the CME Group's Fed Watch tool. The annual symposium comes at a critical juncture for the US economy. Interest rates have been at their highest level in decades for more than a year, pushing inflation down and slowing economic activity. The unemployment rate simultaneously has risen, giving Wall Street reason to believe the Fed will begin to cut interest rates in September. Just yesterday, we learned some even more disturbing news that might have been artificially propping up the stock market all year, and we definitely need to consider this. U.S. job additions revised lower by 818,000. Largest revision since 2009. U.S. unemployment rate is up to 4.3%, which is the highest since 2021. 5 out of the last 6 jobs reports have now been revised lower. A record number of Americans are now working multiple jobs. The U.S. dollar has lost 25% of its purchasing power in 4 years, and 11% of credit card balances in the U.S. are now delinquent, the highest in over a decade. None of that is good news, and all of that is cause for concern, especially for those of us invested or interested in investing in the stock market. Understanding whether or not there will be a rate cut, and even more important, how fast and for how long, is so crucial. Federal Reserve officials have said they're increasingly confident that they've nearly tamed inflation. Now it's the health of the job market that's starting to draw their concern. With inflation cooling towards its 2% target, the pace of hiring slowing, and the unemployment rate edging up, the Fed is poised to cut its benchmark interest rate next month from its 23-year high. How fast it may cut rates after that, though, will be determined mainly by whether employers keep hiring. A lower Fed benchmark rate would eventually lead to lower rates for auto loans, mortgages, and other forms of consumer borrowing. Since the market tends to react quite emotionally, I wanted to point out a couple data points and a couple things historically, and give my thoughts on what could happen at the meeting tomorrow and how to invest because of it. So even if Powell takes a dovish stance, which just means that he's talking about rates being lowered, it might not have that much of an immediate impact on the market. Bank of America securities analysts recently noted that the S&P 500 historically has had a limited reaction to Jackson Hole. Granted, there are exceptions. Stocks plummeted in 2022 after Powell struck a hawkish tone when addressing the need to restore price stability. But this year, they forecast isn't likely to be exceptional. With rate cuts already priced into the market, upside on even a dovish Jackson Hole speech is likely limited, the analysts wrote. I don't think the Fed has to fear inflation, said Tom Purcelli, U.S. chief economist at PGIM Fixed Income. At this point, it's right that the Fed is now more focused on labor versus inflation. Their policy is calibrated for inflation that is much higher than this. Still, how fast the Fed cuts rates in the coming months will depend on what the economic data shows. After the government reported this month that hiring in July was much less than expected, and that jobless rate reached 4.3%, the highest in 3 years, stock prices plunged for 2 days on fears that the U.S. might fall into a recession. Some economists began speculating about a half-point Fed rate cut in September and perhaps another identical cut in November. The issue that I have right now, and that I think most people have right now, is that they're saying that they're going to base this off of certain numbers or certain data that they have. and that's going to point them to what they're going to do next. And then months later, we find out that they were actually off by 800,000 jobs. Like, how can you be off by that many? Almost 1 million jobs. Someone definitely needs to go back to class and learn how to count. That's not a small error. That has potential to totally shift a whole situation. My thought for Friday's meeting, though, is that if Powell actually gives direct information, like exact or at least very understandable information about how this rate cut's gonna happen, when it's gonna happen, and we can actually see a timeline, I do believe that the markets may rise sharply just for at least a brief moment, only because a lot of people are going to feel a little bit of hope knowing that rate cuts are coming down, which means in the future, borrowing money is going to cost a lot less, especially for a lot of people that have been trying to buy a home, people that are feeling it in their credit card statements, things like that. So them saying, okay, we're gonna cut this rate now, it's gonna sound like a good thing, at least initially, and people are going to buy that up. However, if the Fed actually does need to cut rates, what this is basically saying is our economy is not in a good situation. It's not in the best place, because we can't handle rates being this high. And we can see that with all these negative reports. Things like jobless claims going up and hiring not being as fast as possible and things like that, those are not good things for an economy. So by the Fed coming in and kind of saving us and bringing down the rate, that's supposed to ease some things, and that's gonna help the economy get back to where it should be. So that's why I think that the stock market might rise a little bit on that initial good news, but then it's gonna come right back down or at least stabilize. I do believe there's gonna be a lot of volatility coming in the near future. All I know is that once those rates have been brought down all the way, whether that takes all the way till 2026, maybe till 2027, and the economy gets back to firing on all cylinders like we're used to in the past 10 years or 15 years or so, we're gonna hit a solid bull market, one that we haven't seen before, in my opinion. I think it's gonna be even crazier than what we saw over those last 15 years because of this big AI and tech boom. So all I know is once that bull market starts and it gets going, it's gonna go fast. And so I will have wanted to have as much money as possible invested at that point. And we don't know when that's gonna be, so it's hard to time it. We can't just hold our money out until that last second and then put it in. Most of you that are holding money and trying to time the market, you're gonna get it once it's been going. So you're not gonna hit it at the bottom, you're gonna get it like in the middle when you see some patterns and trends. What I'm making sure to do right now is just continue to dollar cost average and get money in. The stock market, while it's been going up and going down, overall it's kind of traded sideways, with a little bit of a growth this year, which is kind of crazy, but we will see some drops and it's gonna level everything out anyway. Even if we look back and over these last 3 years, the stock market kind of did this, that's kind of a good time to be accumulating. That's a good time to be throwing money in while the stock market preps for this big upswing. You make money by investing before the bull market takes off, not while you're in the bull market. So tomorrow, if the market drops a bunch because of this news, I'll definitely buy because that's an emotional response and it's irrational. But if tomorrow there's some good news and the market goes up, I'm not gonna be buying, I'm not gonna be thinking FOMO, I'm not gonna be doing anything because I know that it's gonna kind of correct and level back out. At that point, I will still continue to dollar cost average like I will be doing for the next 6 to 12 months, to be honest, because I think that the volatility with the presidential election and the new policies that'll come with the new president coming at the beginning of the next year, a lot of things are shaping up to possibly go up or go down, and either way, dollar cost averaging makes sure that you get the best of both worlds. I'll be throwing money into those great ETFs with low fees that have been around for a long time with a lot of data. And so if you want to check out my 3-fund portfolio, I would highly recommend that you check out this video. And if you've already seen that one and you're already investing with a lot of other people loving that portfolio, then check out this video to keep you going strong in your investing journey.